Hello, everyone. My name is Zulfiqar, and welcome to another episode of Income Investors. With me today is John Whitefoot. But before I go into any details, I want to let you know that anything you hear in this video is for information and educational purposes only. Investing comes with risk. No matter how safe an investment sounds, there are risks involved. To read more about it, please see the description below. With rates on the rise and money tight, now's the perfect time to look at interest rate sensitive stocks like business development companies, or BDCs for short. And in particular, Barings BDC Inc. traded on New York Stock Exchange under symbol BBDC. Why, you may ask? BDCs operate in much similar way as your traditional financial institution. They borrow money at low interest rate and then lend it out at a higher rate. This profit, called the spread, comes from the difference between the BDCs receives in interest and pays to creditors. John?
Yeah, exactly. Like traditional banks, BDCs have nationwide operations and provide loans to customers in various industries. Unlike big impersonal banks, BDCs don't serve the general public. They have no branches, no ATMs. Moreover, they don't provide mortgages, checking accounts, or credit cards. Instead, they loan out capital to small and mid-sized companies. And by that, I mean small and mid-sized companies that generate between 20 and 100 million in annual sales.
And John, before we go into details, I think it'll be a good idea at this point we do a little bit one-on-one on BDCs. I was reading there are a lot of advantages to this business model. For example, higher interest rates.
Yeah, exactly. Because these clients have fewer other options to borrow money, BDCs can charge above average interest rates. For instance, a commercial bank might earn as little as 3 to 5% on its portfolio. By comparison, BDCs collect yields as high as 10%, 12%, and even 15%.
And I know they also offer senior loan status.
But yeah, exactly. BDCs usually have senior status on their loans. This means they stand first to get paid if something goes wrong. That further lowers their default rate and allows shareholders to sleep a little easier at night.
And I know their overhead is not that high.
No, exactly. As we sort of hinted at earlier, running a bank branch isn't free. You have to pay for the land, the building, maintenance, never mind the salaries of the tellers, managers, and support staff they employ. BDCs, on the other hand, don't have this problem. Without a branch network to keep humming along, almost every dollar they make in lending profits flows straight to the bottom line.
And this is a big one for me, that leverage, very little leverage versus, your typical bank.
Yeah, exactly. And this is like a big strength for BDCs. The US government requires traditional banks to maintain a leverage ratio of 5%. In other words, institutions only need to keep $1 of capital in reserve for every $200 they lend out. That explains why the industry needed such a large bailout from the Federal Reserve during the 2008 financial crisis. Without any financial cushion, even a few defaults pushed banks into insolvency. BDC, on the other hand, must maintain at least 50% leverage ratio. They can only lend out $2 for every $1 of capital on their books. So this leaves companies with much less exposure in the event of a downturn.
And what about the liquidity at BDC?
And that's part of the joy of BDCs. Many BDCs list on public exchanges like the New York Stock Exchange and NASDAQ. So you can buy and sell shares just like ordinary stocks and begin getting quarterly and sometimes monthly dividend payments.
Now that we have that covered, let's talk a little bit about Barings BDC. What can you tell us?
Yeah, thanks. Barings BDC is an externally managed business development company that primarily makes debt investments in middle market companies. BBDC's investment advisor is Barings LLC. And for the record, internally managed BDCs have their own staff, analysts, managers, and executives to manage the company's assets. Externally managed BDCs outsource the tasks to a third party. Now, getting back to Barings, the company generates income by investing directly in privately held middle market companies that operate across a wide range of industries, including manufacturing and distribution, business services, technology, transportation and logistics, consumer products and services, etc. It does this by investing in senior secured loans, first lien debt, second lien, equity co-investments, and secured private debt. It also specializes in mezzanine, leverage buyouts, management buyouts, acquisition financing, growth financing, etc. The various kinds of loans might sound like a garden salad, and some loans are more desirable than others. So it's important to know, what kind of BDCs you're looking at. For instance, a BDC with a lot of senior debt stands to get paid back first. Mezzanine lenders get paid second. Meanwhile, preferred and equity investors usually receive only a fraction of their original investment back in the event of a bankruptcy. And again, to repeat, Barings' portfolio is focused primarily on first lien investments.
They seem to be making decent amount of money lately.
Yeah, you'd hope that as a BDC, they'd know how to make money, and they do. In the first quarter, total investment income jumped 53% year over year to more than 67 million. Net investment taxes were also up 45% at 27.5 million or 25 cents per share. The company also announced a big 89% increase in net assets resulting from operations of 39.7 million or 37 cents per share.
And John, let's talk about the most fun part here, the distributions. I see that they've increased to 25 cents here.
Yeah. As already noted, thanks to strong net investment income, the company was able to maintain its quarterly distribution at 25 cents per share or $1 on an annual basis for a yield of 12.33%, which is massive. I mean, it's far better than the current inflation rate of 2.9%. But the payout represents a 4.1% increase over the 24 cents per share paid out in the same period last year. At the current pace, the company is set to distribute $1 on an annual basis, and that would be up 5.2% over the 95 cents it paid out last year. Barings BDC actually has a history of raising its annual distribution, and it's done so since it paid out 54 cents per share in 2019.
And John, how have the BBDC stock prices have done recently?
Well, everyone loves a growing dividend, but it's even better when it's accompanied with a growing share price. And after years of decline, which impacted the broader BDC sector, Barings BDC Inc. stock is starting to rally higher. It's up 6% over the last month, 11.75% over the last 3 months, and 5.5% year to date. It's trading at around $8.11 per share. BBDC stock is actually doing a lot better since the pandemic too, up 132% over its March 2020 lows of $3.49. Barings BBDC stock is also up approximately 5% over its pre-pandemic levels. And the consensus on Wall Street is that BBDC stock will continue to rally higher, with analysts providing a median 12-month share price target of $9.50 and a high estimate of $11 per share.
John, thank you so much for your analysis. Baring BDC Inc. is a business development company with a diversified funding mix, primarily made out of first lien investments, with overall debt split roughly 50-50 between secured and unsecured debt. In the first quarter of 2023, the company took advantage of more lender-friendly environment, sourcing 145 million of new obligations. Net investment income covered its high yield dividend as its largely floating rate portfolio yield increased on heels of broad credit stability within its portfolio. Speaking of dividends, Barings BDC's quarterly distribution has climbed from just 3 cents per share to 25 cents per share in the second quarter of 2023. And thanks to strong net investment income, it should be able to continue to raise its dividend even further in 2024 and beyond. That's it for today. We'll be back with another video soon. In the meantime, don't forget to like this video and subscribe to our channel. Goodbye for now.